Okay, so today we're going to have a conversation, a couple loan officers with Nexa Mortgage, and just knock around some ideas about our journey as loan officers and our experience and how it came about that we decided to look at Nexa as a platform to run our business. And today our special guest is John Leidel. Uh, John, how many years have you been in business?
I came into the mortgage world a little over 11 years ago.
Fantastic. So, what all companies have you worked for?
So I cut my teeth at Wells Fargo on the banking side, left Wells, and then did correspondent with guaranteed rate, and then left guaranteed rate to come to Nexa.
Gotcha, gotcha. So, what was it that was appealing to you to even want to look at this?
Um, having seen the banking side and then having seen the retail correspondent side, I was wanting more control over my loans. I was wanting a greater product suite as well. And quite honestly, I was wanting to get paid more on the loans that I was originating. So that's what
Right.
had me kind of start poking around. That's when Nexa came across my desk.
I gotcha. So, yeah, it's interesting. 15 years in the business, my company had merged and changed, multiple times, stayed with the same people, but they were going through another merger. And I'm like, you know what? Golly, man, I hate this. We're going to have another LOS system to learn. I'm not bringing on my database. It's disruption. And you know what? They promised me, hey, we're going to have all these new specialty products, but I was always held in the dark. Felt like I was in the dark anyway. So when you came over to Nexa, is the pay really more?
I mean, yeah, it's a significant increase. So I was making 90 basis points for me to be competitive in my market at guaranteed rate. We got to choose our comp, which affected our rate. So for me to be competitive in this market, I was getting 90 basis points alone. And then for jumbo, I had a cap on jumbo. So I was capped out of, in that case, 3,400 bucks on a jumbo loan. And then they claimed that they would take what would have been my excessive comp and applied it to buy down the rate. I don't know that those jumbo rates were that competitive, but I was capped out at $3,400, which is ridiculous to think about if you're originating $1 million loan.
Yeah. Yeah, I had something similar. We were at 100 bips, and then quarterly you could make an extra 10 bips if you hit certain threshold levels. And then on jumbos, I was capped at 5,000. What kind of comp do you normally see on a just a regular loan here, FHA, conventional, jumbo? What kind of comp levels are you seeing here?
Yeah, I mean, after everything's said and done, I'm probably averaging between 190 and 200 bips a loan.
God.
So, I mean,
What's
huge,
that?
huge improvement. I mean, double what I was making a guaranteed rate, plus all the other benefits I have of basically running my own shop, the product assortment, the speed to execution, like all the other things that go along with it. So it's been a night and day difference.
Yeah. So, when somebody tells you that, I mean, I'm always one of these ones, the grass on the other side of the fence, just hard to mow as this is. And if you're making that much comp, then your rate would be terrible.
Yeah.
Are you beating the retail rate at that?
Yeah, I mean, I get every once in a while I'll get somebody shopping me and they'll provide me some rate sheets or some, loan summaries from other lenders. And I'm typically right there. And if I need to beat it, I'll drop down and still make 175 bips and really
Exactly.
and really
Exactly.
beat the rate. So
Yeah.
yeah, it's the rates are certainly competitive. So that whole thing that everybody used to say when I was at Guaranteed Rate, well, they started saying it when I was at Wells Fargo. Oh, the banks have the best thing. Correspondent doesn't have it. Then I go to correspondent. They say, oh, well, don't go to the broker world. You can't close anything. The rates aren't that good. Like, you got to stay here. It's just all fear and people just trying to keep you in one place.
Smoke and mirrors.
Yeah.
The thing they told us was, hey, over here we've got you a processor. Of course, she was probably shared with like five LOs or whatever. And half the time I was chasing down the stuff, she's just pushing it on to the next level. They said, hey, we have internal underwriters, but at the same time, they would tell us, no, you can't call the underwriter. We don't want to slow down our turn times, stuff like that.
Right.
Or if you got a tough underwriter, there was no gray area. I mean, hey, you might could discuss it, but most of them would lock down on you. That was it. You wasn't getting anywhere. In
Yeah.
fact, the branch manager couldn't even, he didn't have any power over them either.
Yeah.
So what if he found?
It was very much I always felt like at Wells and also a guaranteed rate, and nothing against guaranteed rate, but it definitely felt like I was playing offense trying to close loans and underwriters were trying to prevent me from closing loans. It never felt like a partnership with me as the originator, in lockstep with the underwriter trying to serve the borrower.
Yeah. So what avenues and uh ways do you have to combat that here?
I think first and foremost, the other thing that I learned when I was at Wells, I thought the guidelines were Wells overlays because as a new LO cutting my teeth, they touted that their overlays were guidelines. Like I thought FHA had to be 640. I thought that was a guideline because that's how they presented. You know, Guaranteed rate, not so much, but still to a certain extent. So here, if I have a question about a guideline, I can Google Freddie Fannie guidelines on self-employed income, departure, whatever it is, and I know that the underwriters are going to underwrite to those guidelines.
Right.
And we're on the same page. And if I have a question, I can share. I say, look, here's a selling guide, section 5301.7 on self-employed income. I can share that with them. And like, yeah, okay, you're right. Let's go ahead and take care of that.
Yeah.
And they're willing to actually look at it. And if they're wrong, they go, you know what? I think we're reading it differently, but let me get a team lead involved.
Right.
And they're not offended. They don't feel like I'm trying to challenge them or go over their heads. They're willing to be like, okay, well, maybe we're just interpreting this differently. Let me get another set of eyes on it. They bring in a team lead and we can have a discussion and figure out a solution, which it never felt that way at my previous two gigs at all.
Yeah. 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 So refreshing. I tell you, I mean, it was kind of an eye opener, really. I was like, oh man, this is different. This is cool. Um, as from a delivery standpoint, in terms of the client experience, have you seen any differences in the way you're able to operate here versus the retail side?
Yeah, I mean, there's certainly a noticeable difference. I mean, right off the jump, I don't get over conditioned, right? So I know the guidelines, I know what I have to collect from the borrower up front. So I'm getting those. My previous two gigs, the underwriter would see something and they would just throw these off the wall conditions at me out of the blue, and I'd be chasing paper down. And that's a really lousy experience for the borrower. Like I already supplied this. Well, you supplied that, but then they saw X, Y, and Z, and now they want you to supply more paper because of
That
what.
is true. Yeah.
So from the client experience, there's a lot less documentation. My average clear to close is 10 days. So I'm getting loans cleared to close a lot sooner. So I can tell the bar, hey, we're 2 weeks out from your close date. You're all good. Just sit tight. Worry about moving your stuff out of your other house, not worry about, getting me paper down to the last minute, getting the closing disclosure out at the initial underwrite. So we're not having to wait for a clear to close, which is what I used to have to do. Then they'd get the CD out. Then we'd have the 72-hour cooling off period, which often delayed closing. And then lastly, I think the biggest thing, I would work my butt off to deliver a great experience for my clients, and then we'd get to closing and the wheels would come off. And
Oh
that
God.
always killed me because here I am, 27, 28 days, whatever it is, delivering the best experience I can deliver, and then it gets to closing and the wheels come off, and that's what they remember because that's the last,
Right.
3 days of their experience. Now with closing here, my closings are so much smoother. I can get a CD balance in a couple hours. Like it's just easier, and I can tell the clients, yeah, you're good to close, and I'll see a closing and not be surprised with some last minute condition that pops off by some underwriter who thinks they missed something.
Yeah. So along the lines of the client experience and delivery of product, some of the things that I saw was we had a process for getting a CD out way early up front. As soon as it comes out of underwriting, bam, we send out the CD.
Mhm.
So that 3 day waiting period is eliminated. It basically takes a week out of the process.
Mhm.
Um, And I noticed all kind of other little nuances that I never really thought about in retail, but it's kind of mind blowing. Like we can lock exact days.
Right.
We can lock rates that are exact. Let's just say 6.92, 92, or instead of a 6.97 or six, call it 6.875 and then go all the way to seven. We had the ability to waive escrows and
Yep.
not charge a quarter. That's a huge
Right.
deal when you're
Yep.
trying to make a deal and somebody's low on cash to close. I mean, they're just, I could list probably 10 or 15 different ways that we have the power to, manage our file, give the client a better experience. And it's been really refreshing to have that.
Yep. Yeah.
Um,
The exact rate and the exact rate times, getting 5 days free extensions on all my loans without having to charge the
yeah,
borrower, being able to lock for 32 days instead of 30 or 45,
right.
all those things, the exact rate that you spoke about. Yeah, huge differences.
Awesome. So, from I don't know about you, but I mean, the thing that kept me from looking at a broker channel model forever, I mean, number one, my bosses were always telling me, oh, those guys, they don't have any support. They don't have this. They don't have underwriting. They don't, you know, and honestly, I just believe that.
Yep,
Come to
me
find out,
too.
all that was not true.
Right.
But also, too, um, what's amazing to me, and it was another thing that's super refreshing is we're dealing with all the lenders that buy all the loans anyway. I mean,
Right.
these guys call the shots. Half
Right.
of them service their own loans, and they're empowering us. And it's amazing. They'll fly us up to corporate and train us by their top guns, and they help us with closing gifts and things of that nature. In some cases, it's just so completely different. I mean, than what I was experiencing.
Yeah. The lack of support was always something that retail correspondent tried to woo. If you go to the broker world, you're not going to get any support, and that was certainly one of the first things when I looked at Nexa, with the LOS platform. God, it was so long ago. It wasn't even called LOS; it was called something else back then. But the ability to log in and talk to an experienced loan officer who's been a broker for a long time and say, "Hey, I've got this weird one-off scenario with this or that. What kind of lenders have an appetite for this?" And they can say, here's 3 or 4 lenders that have an appetite for that type of property or that type of loan scenario. And then be able to actually talk to the account exec at that lender and say, here's my scenario. Here's a 1003. Do you guys have an appetite for this? And one might say, you know what, we really don't. But then I'll talk to another and say, yeah, we've got an appetite for it. Let me walk you through how we can get it done. So the level of support is actually greater, I think, than it was in retail. And now with the advancement of LOS, of loan officer support, I can log in and talk to most of my lenders directly on Zoom and share screen and say, hey, I'm bumping up against this thing here. And they can walk me through it in real time. Like, that's huge.
I know. I think, we're a technology company and we're embracing that, and we're just relentless on improving on that and, every day. But that has been huge. The other thing that I kind of saw the writing on the wall, I made my change in May of 2021. I figured, hey, rates are going to start heading up. I want to be competitive. I want to
Mhm.
have tools to fight. And the other thing that was kind of an added bonus was all the products.
Yeah.
I mean, I never had, I know a lot of places now have a broker division that they're brokering off bank statement loans and P&Ls and DSCR loans. And, here we have commercial, we have one time closed construction. And
No,
I mean,
no ratio, no income.
yeah,
Yeah. Asset
yeah,
depletion.
yeah,
Yeah.
it's sky's the limit now. So, when the market gets tough, you got to flow and go with, hey, what comes your way? So it just helps you keep your pipeline going and be a better, be a better partner for your referral partners, the way
Yeah.
I look at it.
Yeah.
But anyway, well, that's great, man. I appreciate all your insights,
Yeah.
your candid experience. You've done amazing. So, I mean, basically, for anybody that's watching this, we'd encourage you, John or I, you could call us up. talk to us, we'd be happy to tell you what we think. We actually mentor people that we bring into the business and help them get to the level that we are, to where you can transition very seamlessly.
Mhm.
And, hey, never miss a beat. Actually, you probably increase, most people that come actually increase their business. Some of them double, triple.
Yeah, and the transition. I mean, transition can be hard. It was hard when I went from Wells Fargo to guaranteed rate, and coming over here was not nearly as bad as I was expecting. I mean, it's a couple little learning curves things, but you were there for me as one of the guys that mentored me, and then all the folks at LOS support, and now we're mentoring folks that we're bringing in, so they can learn from our experience. I've been here since September 2021, so yeah, it's we can make that transition as smooth as possible.
100%. Lastly, I'll wrap up. I mean, it continues to blow my mind how our CEO, he is just relentless on making our platform just so far superior to anything out there. He just rolled out what we call Nexa 100. It's hard to even wrap your mind around it, but basically, you make all the money, and Nexa's getting their what they need to operate the business out of volume bonuses. I mean, we're now at like 24, almost 2,500 LOs. We're projected to be at 2,500, I mean, at 5,000 by the end of 2025. He's rolled out Nexa 100. So it's just call it a pay increase,
Mm-hmm.
ask about it, find out about it.
Yeah.
They rolled out another, what I call the highest level of loan officer power you can get, which is a non delegated correspondent model, where we're like the bank, we're the lender, and we can control the comp built into the rate, just like a bank would. So that's something that's brand new. Not every broker platform out there has that. Nexa is number one in the country. Uh, we are just it's on fire.
Yeah.
It's on fire. That's all I can say. But
Yeah.
anyway, hey man, thank you for your time
Yeah.
today. A lot of good input. Um, we will be out there, and we'll put out our information so that you can
Yep.
reach out and find out about us. And we hope to see you real soon.
Yep. So thanks, man. Appreciate talking with me, Jeff. Appreciate it.
All right. Thank you, John. Have
Yeah.
a good